2008. Obviously, though, these stocks are now much cheaper. The forward PE multiple on the NASDAQ 100 is now about 21. That is the third below its height in 2020 and below the 5-year average of 23. So these stocks are cheaper. Valuations maybe look more attractive for dip buyers. The question is, how many people want to dip their toes in this water with all the headwinds still out there, John?
Kelly, thank you. Seemingly some today, at least, on the S&P 500 up 0.8%, on the NASDAQ up by 1.2. Just yesterday, we caught up with Savita Subramaniam of Bank of America. Take a listen to this.
Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So equities offer inflation protection and cash return. Where can you get those things? Well, a lot of equities have them. Energy, financials, even healthcare staples.
Let's get the BlackRock view from Jean Bavin. Jean, great to have you with us on the program. You've toned down your view on equities recently. Just walk me through the thinking.
Great to be with you, John, this morning. Thanks for that. So the main, it's all about the policy landscape and the Fed in particular, I would say. We have been, overweight equity. By a lot of the arguments we've just heard about, equities are attractive in an inflationary environment and will continue to be, but there's been a significant repricing of the policy path in the U.S. Over the course of the last few months. Very significant. We don't think that ultimately that policy hiking will be fully delivered. But for the time being, the Fed is really playing for the inflation, politics of inflation. And until that changes, I think we're going to be in an environment where, it's difficult to see, a buy the dip mentality working out. I think we're gone the days of just simply buying the dip. It's a different kind of environment. And so we'll need to have clearer signals on how the Fed is framing this environment before we see, a more constructive rate landscapes supporting equities.
Jean, you were previously overweight. There might be some people, they might be rude, they might turn around and tell you this is like closing the barn door where the horse is already about 2,000 miles down the road. What would you say back to him, Jean?
Well, I think we're adjusting to a pretty significant backdrop that has changed in terms of the rate side of things. I would say, our biggest conviction underweight was on fixed income government debt, which we thought yields will have to go up. We still believe they have to go up from here. So that has played out, partly in the long end where we think that has more to continue. There's been more noise now on the Fed front, and we're acknowledging this. We think ultimately central banks will have to pivot to a more dovish stance. And as a result, we will see eventually a more constructive environment. But right now, we think it's better to be neutral. Just to be clear, we're falling back to neutral, staying invested, but neutral. And we think they're going to be better entry points, still over the next few months until we get clarity.
On the central bank story, here's the quote on the Fed from you and the team. You said the path of short-term rates is less than what the market is pricing in now. That's what you expect. On the ECB, you say we see the path of market pricing too aggressive. You see that both at the Fed and the ECB as well. You mentioned there that they might have to pivot. So let's talk about that, Jean. What's going to trigger that move? What's in the path forward, in your view, that you think triggers that move?
Well, I think it's important to maybe take a little step back to see why we think of this way going forward. But last year, we had commentators and the Fed, I think, central banks in general, oversimplifying the story of inflation with framing it around a time frame, right? Which was temporary, which we don't use anymore. That turned out to be wrong, could not be sustainable as a story, so we shifted away from that. But unfortunately, I think we've shifted to an oversimplified story again, which is one where we're going to raise rate until inflation is under control. But that's trivializing the world we're in. The cost of bringing inflation quickly back to 2 would be extremely acute, high, and I think that's going to become clear over the next few weeks and months. And as this becomes clearer, I think there will be no choice but to acknowledge a trade-off that is not as simple as simply raising rates until inflation is tamed. So that's the trigger is acknowledging these costs, which will be pretty real and will come clear over the next few weeks.
So, Jean, this is really, really important. Fading the tightening story at the Fed isn't necessarily good news. It can mean inflation is coming down because the supply side surprises in a positive way, or it can just mean the economy can't handle it. So, Jean, just be more specific for us. Which one is it, and what implications does that have for how you allocate capital?
So we don't think there's a nice Goldilocks scenarios in the middle, which I think is what you're getting at. I think either we're getting a world where we're slamming the brakes, we're insisting on getting inflation back to 2, which I think is a world where we're going to see a recession. I don't see any homegrown reason or endogenous reasons for a recession to happen. It's not a typical recovery that leads to a recession, but if the risk of over tightening could be leading us there. The alternative, which is what we think is going to be ultimately the most likely scenario, is we're going to live with somewhat more inflation. So it's not a great scenario. It's not like a Goldilocks like we might have seen over the last 20, 40 years. But it's one that I think is more benign than a recession one. And that's why we expect a bit more inflation than the market is expecting. We see rates going not as far up ultimately, but at the same time lower cost in terms of economic activity.
So Jean, coming into this year, my thoughts on fighting the Fed, a lot of people would say don't fight the Fed. And I had to think about, well, what does that mean for 2022? And what I thought it meant would be inflation protection would no longer be needed because this Fed doesn't want inflation anymore. And ultimately means higher real rates. Are you saying we can fight the Fed? We can fight that effort because ultimately they won't be able to succeed without causing a recession?
Pretty much, that's what I think we're saying here is that it's going to be very difficult to tame this inflation, bring it back to 2 quickly. And it's not something that is caused by, a monetary policy itself. Interest rates themselves are not really addressing the root cause of what we're dealing with right now. Massive reallocation shock between goods and services, the biggest we've ever seen in terms of sectoral reallocation. That won't be solved by tightening policy. I think that's going to become clear. And if we try to do it, it's going to be extremely costly. And so I think that's what, don't fight the Fed or fight the Fed, I don't know, but it means not buying the idea that inflation will fall back quickly to 2% and connecting that to rates rapidly increasing.
Jean Bavin of BlackRock. Jean, stick with us. We've got some data out in just a couple of minutes and Mike McKee's going to drop by and break it down for us. Jean, thank you. We are positive by about 0.5% on the S&P 500, on the Nasdaq higher by about 1 percentage point. Coming up just around the corner, jobs day in America and a ton of economic data.
The Fed's pretty convinced that they need to go to something close to neutral and, expeditiously is the way that they put it. And so that's what they're doing. I think that the economy is going to have enough momentum to keep the Fed so the Fed will keep going into the fall.
That conversation up next.
Fed's pretty convinced that they need to go to something close to neutral and, expeditiously is the way that they put it. And so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed so the Fed will keep going into the fall.
Bill Dudley there, the former New York Fed president. On the economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Some fresh data coming in from S&P Global. It's U.S. manufacturing PMI out. And as is the case around the world today, it's basically a story of stabilization with the number coming in at 57, down from 57.5. However, a little bit less than the market thought, but it doesn't really matter all that much. It's a kind of a rounding error in this case. And it does suggest that the manufacturing business has stabilized. Of course, top of the hour, we'll get the ISM number, and that'll get a lot more market attention. But around the world, same story. We've had some slight changes in the manufacturing ISMs for Germany, France, Italy, the Eurozone, and the Euro-K. Some up, some down a little bit, but all still in the 50s, all still suggesting manufacturing is expanding around the world, and that's what the central banks want to see as they are raising rates. Rest of the week is going to be interesting. Here are the most important things that we're watching. The ISM, as I mentioned, we'll also look at the prices paid as part of that. Auto sales are those starting to be affected by higher interest rates. Jobless claims, everybody's canary in the coal mine. And then, of course, Friday is Jobs Day and ISM services. I mentioned at the bottom there, the Fed balance sheet. This is June. We're starting the balance sheet reduction this month. Doesn't really start until the 15th when the first bonds start to roll off. But people are going to be watching. Nothing's going to really happen or change in the markets, John, for some months because we're talking such huge amounts of money. But it does begin this month.
It's finally here, and you asked the chairman himself for the news conference, why did we wait so long, but we can go there another day. Mike, JOLTS data, it's taken on this new importance. What do you make of that?
Oh, it's just people trying to figure out where the Fed is going, and the Fed is, we know, going 50 in June and July, they say, unless they come out and change their mind. So then what happens after that? And there's a feeling that the jobs data will help them make a decision because, as Bill Dudley was pointing out, the Fed is probably going to be pushing the unemployment rate up. It's been going down. It's forecast to go down again. So when do we start to see a change in the employment situation because interest rates are higher? That will give the Fed a clue as to how their medicine is working.
Mike McKee, thank you, buddy. As always, going through the data, the PMI behind us, ISM coming out in about 10 minutes. You get JOLTS data, job openings in America as well. On to tomorrow, we get ADP, jobless claims. I think we get some factory orders, durable goods, capital goods orders in the mix as well. Then on to payrolls Friday. Jean Bavin waiting patiently for us. John, thank you for that. Let's frame the debate with the Fed. And we know your view now. You've got the one side of the conversation, the debate, the argument that the Fed is going to keep on going. Think Bill Dudley. He thinks the economy is resilient. They'll have to do more. Your view, the Fed takes a pause. I often think about this, often ask this question, how and when would you know if you're wrong? Where on the calendar can you identify when this argument gets settled one way or the other, John? Where is it?
I think they're going to 2.5 or close to that level by the end of the year. We'll see. We'll get a better sense as we get closer whether this is close to what we think is neutral. We've already seen a pretty sensitive market to this repricing of rate hikes. So I think this is a sign that we'll get more and more evidence that neutral might be, not that high in this cycle. But I think by the year end, we'll get to that point where the Fed has framed things around two phases. We're going to try to go back to neutral swiftly and then reevaluate. And that's going to be then a question about what we do next. And I think this is coming into sharper relief, by the year end. And so that's the horizon we're looking at. Getting close to neutral as quickly as possible, I think that's a kind of a 2.5 number that we are looking at. And once we're at that number, reevaluate.
John, just to lead on your central bank experience, as you know, it's impossible to know where neutral is in real time. Monetary policy operates with long variable lags. You know that quote, we use it all the time. John, how do we know any of this stuff where neutral is, and ultimately, do we find out too late? And if it's too late, we've already made a mistake, haven't we?
Well, I think one of the things I find a bit troubling in this environment is that we've completely lost this story about being forward-looking when it comes to central bank. All of the communication is kind of backward-looking. We've talked about framing things like we're going to hike until inflation is tamed. That's an example, right, of where by the time we know that, it's going to be too late. We're going to have overdone it. There's a bit of a worry here of being in the mode of backward-looking policy making, and I think also solving for politics. I think where the politics of inflation is really like the driver here, and there's a bit of a rear view mirror here story that is at play. But I do think that we won't never know whether we're at neutral, but we'll see sign of pressure cracks that I think will be more apparent, and they'll start to build a narrative around that, and we'll see some part of the committee making these arguments more forcefully as we get closer to the end of the year.
We've got to leave it there. Great to catch up, as always. Jean Bavard there at BlackRock. We saw the politics of inflation on full display in the last day or so. Your equity market's positive by 0.5%. Your trading diary is up next. And 26 minutes in, stocks are higher. Here's your trading diary. ISM manufacturing numbers coming up at the top of the hour. Some Fed speak from President Williams and Bullard following the Fed beige book a little bit later. President Biden meeting with baby formula manufacturers at 2:45. Another round of jobless claims on Thursday, and rounding out the week with a big one, the payrolls report. Job openings a little bit later too. Ton of data this week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, June 1st. Here are the top market stories we're following for you at this hour. Let the QT begin. The Fed starts shrinking its massive balance sheet today. It's a runoff versus tightening. We'll look for where strains in the financial markets may appear. And finding deep value, Howard Marks of Oaktree sees opportunities in growth as well as India and China. More from our exclusive interview with a legendary investor. And jolting the jobs market, the latest read on hiring, inflation, and manufacturing with Tim Fiore, chair of ISM's Manufacturing Business Survey Committee. From New York, I'm Alex Steele, my co-host in London, Anna Edwards. Guy Johnson is off today. Welcome, everyone, to Bloomberg Markets. First day of June, equities on the front foot, economic data front and center.
Yeah, economic data front and center. European markets struggling to find much direction, although U.S. markets giving a little bit of that. But it is a bit varied. Doesn't feel as if perhaps there's all that much commitment behind it because we're quite low on volumes here in Europe. So we'll return to that theme. Let's get to some of that economic data that Alex was just mentioning. And we'll go first to the jolting the U.S. economy. See what you did there, Alex, in the headlines like that. So we've got JOLTS job openings coming in at 11,400. So that's 11.4 million. Essentially, and that is almost in line with what we were expecting. 11.35 million was what we were expecting. It's down a little bit on the prior period, but it is more than the survey. And if this is part of the continual recovery in the jobs picture in the United States, then we're certainly still seeing that. We got down to levels of around 5 million back in 2020. A lot of people starting to ask questions, when do we get more job openings in the U.S. economy than we have unemployed people in the U.S. economy? We certainly got to that particular landmark event here in the UK some time ago. So interesting to keep an eye on the tightness of this labour market right now, Alex.
All right, here in the U.S., you got the ISM. Manufacturing, prices paid, new orders, all coming in stronger than estimated, particularly the new orders coming in there at 55.1, and the manufacturing index coming in over 56. The one lighter area, though, that missed estimates a touch is ISM employment coming in under 50, which is usually that expansionary mark. Equities, though, not reacting that much at all. You still have S&P up by about 0.4%. Let's dig into the numbers here, because the question really becomes, what kind of demand destruction do we see from higher inflation? That's what the Fed's watching. That's what markets are going to be watching. I want to bring in Tim Fiore, chair of the ISM's Manufacturing Business Survey Committee. Hey, Tim, it's great to see you. What was your biggest takeaway from the ISM today?
Well, not to avoid the employment number, which we'll get to shortly, I think the greatest news here is that demand, after softening slightly in April, bounced right back. And all four sub-indexes that I use to track demand all reacted positively. The customer inventory number, the backlog number, particularly new export order, was a little bit soft, but not a big surprise with Europe and China, and the new order number popping up. So it feels good. I mean, the sentiment of the panel was 5-to-1 positive about future demand, which is makes you feel real good. So I think demand is stable, solid. There was a little bit of concern in the April timeframe, but it seems to be rectified. But there are some signs in some industry sectors that we're seeing a little bit of slowing in expansion, primarily in those sectors that support the building industry. We had comments from the chemical industry sectors and fabricated metal products and non-metallic materials where there's some indication of some softening, not a big surprise.
Timothy, good morning. Let me ask you about that a little bit more then, because from what you said at the beginning, it sounded as if any weakness was coming from overseas, and actually the U.S. dimension here was really strong, but then there is maybe some weakness in construction. Talk us through that a little more.
Right. So I go through the comments and I look for people feeling that things are slowing a bit. It's time to start to look for that, because at some point it will happen. And I came up with slightly less than 10% of the general comments indicating that things may be slowing, not things are slowing. So there's 18 industry sectors that make up the manufacturing economy. I looked into those, and there were three that kind of stood out. Non-metallic materials, that's a big building construction area. Chemical products, it's a foundation element that goes into a lot of other materials. And fabricated metal products, but that does the same. So, I mean, it's not widespread. It seems to be industry specific. And I guess not that big of a surprise given what's happening now with the housing market.
Yeah, Tim, I wanted to get your take on that. Is it more of a supply issue, right? We don't have the construction material to build the stuff, or is it an underlying demand issue?
Well, the indications were it's demand, but it could also be that there's over-ordering and that people have really pumped up the purchase order pipeline over the last year to account for long lead times. We're still sitting at record lead times. That hasn't budged. You did see that the price index eased a little bit, which is a positive sign. And our supplier delivery index came off a little bit too, which is a positive sign. But we're not seeing dramatic movements in those. We're seeing slow and steady improvement, post the Russia invasion of Ukraine. So we're moving in the right direction here, but it's going to be slow. And let's get to the employment numbers. So we did contract. Not a really big surprise. We're dealing with very significant quits. It seems to be slowing a little bit, but not very much. And although our panelist companies are getting better at hiring people, they're still losing people. As you saw just recently, I think we set records in the month of April, I think it was. So that's still continuing. There's still a chase for wages. And until that employment number really comes back, our production number isn't going to get into that high 50s that we're really looking for.
Okay, and let me ask you about any clues you've got for us, Timothy, around inflation. Looking at the prices paid component here, the actual number coming in at 82, above the survey, but lower than the prior period. Any clues as to where the inflation narrative goes?
Well, it's in transportation, it's in energy for sure. There seems to be some topping off. We just recently did our forecast for the second half of the year, and we're feeling that the prices are up about 11.4% compared to December of last year. But we believe by the end of the year, it'll be up 11.1%. So that kind of indicates that we're at the peak of growth, and that will have a slow come down, not even 100 basis points here, but will come down slightly as we close on the year, which means that we're moving more towards equilibrium. I think it's, I think this is a really strong month at this point in our 24-month manufacturing expansion cycle. It's really positive. As I've mentioned before, our typical cycles are about 34 months. I feel that this one will be longer. If the Fed doesn't do something on the interest rate side next year that could slow it down faster. But I think we're in a great trajectory here. There's still a lot of demand out there. Supply chain is getting better, and you can see it with some of the sub-indexes. We're still struggling with conversion, and that's primarily due to labor issues on the factory floor, which is driven really by the quits there.
Hey, Tim, maybe an unfair question, but if the Fed looks at this number, is this the kind of number where they're like, okay, great, economy is good enough, but demand's too strong still. We're going to have to hike a lot more than just 2 50 basis point hikes over the next few months?
Well, I can't speak for them, but sitting at 1% federal funds rate is still really low. I mean, it's a long way to go towards what is equilibrium. So I don't think that they would be disappointed in this number. It doesn't feel like it's an overheating number. And it doesn't feel like it's collapsing towards the 50 level. So, I mean, if we ran 55 to 58 for the next 6 to 9 months, that would be really good. I mean, every 2.5 points here in the PMI is approximately 8 to 10% improvement month over month. So, we're doing much better than April.
Timothy, thanks very much for joining us. Good to speak to you. Timothy Fiore, Chair for the ISM Manufacturing Business Survey Committee. Let's get to some other breaking news we've had just in the last few minutes, and that comes to us from Bank of Canada. Of course, we're monitoring rate hikes across the globe, as that seems to be the dominant narrative, not in China, of course, but many other places. Bank of Canada hikes key policy rates by 50 basis points to 1.5%. They're warning, another red headline tells me that the Bank of Canada is warning it could be even more forceful if needed. And there was going to be a lot of focus on the hawkishness or otherwise of the statement. This is the second jumbo hike we've had from the Bank of Canada. Another one is currently due in July. That would be a third. Do they pause after that? How will the market interpret that? More forceful if needed. Does that mean could do more than 50? I mean, 50 is what they've done twice, and an expectation in the markets that they will do another 50 shortly. So this is what we see in the FX markets as a result. The loonie maintaining its gain after the Bank of Canada policy decision. Now, coming up on this program, the Fed has another tool to fight inflation. It's shrinking its $8.9 trillion balance sheet. That starts today. Where are the biggest risks from quantitative tightening? We're going to ask Lisa Shallett from Morgan Stanley Wealth Management, where she's Chief Investment Officer. That conversation coming up next. This is Bloomberg.
June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The labor market is the tightest basically it's ever been, and you can see that by the ratio of unfilled jobs relative to the number of people that are unemployed. The Fed needs to loosen that up, or wage pressures will accumulate, and that will keep inflation above the Fed's 2% inflation objective.
That was Bill Dudley, Bloomberg opinion columnist and former New York Fed president, of course, speaking earlier on Bloomberg TV. Let's get to our question of the day. Where is the biggest risk from QT, from quantitative tightening, from the runoff of these balance sheets that we see starting today at the Fed, but actually has been taking place from other global central banks already? Lisa Shallett joins us, Morgan Stanley Wealth Management Chief Investment Officer. Lisa, really nice to have you with us. Let's start on this question then about QT, because it starts today at the Fed, and we're all curious to know what the biggest risk from QT is going to be for markets.
Yeah, look, I think what people need to remember is, the Fed is using two tools. One is the Fed funds rate, which is the cost of capital, and, running off the balance sheet is the amount of capital. And I think, as we've been trying to caution clients about, it's where that quantity of capital and quantity of liquidity has been most beneficial, that its withdrawal is going to continue to be felt. And that is in the most speculative parts of the market, the most richly valued parts of the market. So while I think we've seen a bounce back over the last 5 or 7 trading days in some of those sectors, whether it's unprofitable tech, if you will, whether it's, some strengthening in some of the smaller cap sectors or sectors, levered to, some of the more speculative parts of the market, that's, I think, where we're going to see this withdrawal of liquidity really start to bite.
So, Lisa, I guess I wonder how much of that is already in the market. And I'm just looking at the front end of the curve now, whether you're looking here or in Canada, for example. The Bank of Canada hiked 50 bips. They say we can do more if we need to. We kind of knew that was going to happen. But the market reacted quite strongly anyway. What's appropriately priced?
So, look, I think we need to remember, from our perspective, what's happening on the front end of the curve is all about, what people think is going to happen to rates. What happens on the back end of the curve is very much about what people think is going to happen to the balance sheet. And so I think, we saw, a pullback in the 10-year and the 30-year over the last, kind of 3 or 4 weeks. And our sense is we may give some of that rally in long-duration treasuries back as people begin to further internalize what this withdrawal of liquidity looks like for that longer duration bid.
So that's a longer term story, and as you say, that might be driven by the balance sheet. Let me ask you what you expect to hear next from the Federal Reserve. I mean, we just went through some data on the U.S. economy, the data suggesting, according to our colleagues on the Markets Live blog, that the economy can handle a hawkish Fed. For how much longer do we hear a hawkish Fed, Lisa? Do you have any kind of pivot point in mind?
I think the Fed's going to remain extraordinarily hawkish through September. But I do think that September is going to be a watershed, and it's going to be a watershed in terms of the deceleration of Fed hawkishness, if that makes sense. Mm-hmm. I mean, let's think about it. We're going to, live through what's likely to be 50 basis points in June, 50 basis points in July, potentially 50 in August as we get closer and closer to, Fed funds futures forecast for the full year. And at the same time, that quantitative tightening is ramping up. And we don't get to steady state on those things until September. So I think by the time we get to September, we should have some more constructive inflation data. That will give the Fed some cover. We'll also be approaching the midterm election season when the Fed typically in their spirit of independence, wants to try to quiet down and not get into the fray of campaign season. So we're targeting September for a shift in the tone from the Fed. But it's going to be a rocky summer from where we sit, and the Fed's going to keep their foot on the accelerator.
So, Lisa, this is such a simplistic question, but like, what do you buy and what do you sell on that? In that, if we're in for a higher volatility regime until things calm down, what do you do with that? We haven't been in that kind of regime in a very, very long time.
Yeah, so our advice to clients has been to be a very active asset allocator and be a very active security selector. We're advising, maximum levels of diversification by region, by sector, by exposure to style and quality factors, by capitalization, and we're really just hollowing out the parts of our portfolio exposure that's very sensitive to rates. And so that has left us, surprisingly, very focused on a suite of cyclical-oriented sectors like energy, like industrials, like financials, like some consumer services, and balancing that with some more defensive exposures, most particularly healthcare.
Okay, so that combination of the cyclical and the defenses. On the subject of that cyclical, you mentioned commodities, you mentioned oil. Is that still a good place to hide, Lisa? Do you think we've seen peak oil? I mean, clearly the geopolitics, very difficult to call here, but you have the geopolitics pushing the supply side, but then you have the demand side from China. Where do you think this heads?
I think we go higher before, we get to a resolution around equilibrium. Clearly, we've gone through this period where much of the pressure has quite frankly come from the constrained supply side and what's going on emanating from the Russia-Ukraine war. But what we have to appreciate, exactly to your point, is that China and quite frankly a swath of emerging markets have been, if not slowing, close to a recession. And so as those economies come back, which again we have a very high degree of confidence they will, towards the third and fourth quarter of this year, in large part because we do think that China is going to aggressively stimulate into the next Communist Congress in September when Xi goes for a historic next term. And so, if we see a spike in demand, in the back half of the year, I don't think that the supply situation globally is going to be fixed by then. And so we're looking at least another 6 to 12 months, in our humble opinion, of tightness in oil markets here. And so that trade's got more ways to run.
Hey, Lisa, it was really good to catch up with you. Thank you so much. Lisa Shallett, Morgan Stanley Wealth Management Chief Investment Officer. Coming up, I was wrong. Treasury Secretary Janet Yellen admitting she made a major misjudgment when it came to inflation. More from Washington next. And just to point out here, we're seeing a little bit of a risk-off mood underway. The S&P is now down by about 0.4%. Dollar moving higher, yields moving higher. That really took effect when the Bank of Canada came out with that 50 basis point rate hike and warned of further more to come, and that good data from the U.S. We're seeing a little bit of risk repricing here as we head into the session. Also want to point out that Jamie Dimon, CEO of JP Morgan, is speaking at the Autonomous Strategic Decisions Conference right now. Some really interesting headlines coming out saying on the economy, it's a hurricane. I thought it was a storm before, but now it's a hurricane, and that you better brace yourself. I don't quite know what that means, but he is definitely warning of tightening conditions in private borrowers and saying that you should brace yourself on the U.S. economy. We'll continue to update you on some of those headlines as they cross. This is Bloomberg.
Real chart. If I have to hold twice as much capital as somebody else, then somebody else should own the loan. Now, I may not be able to do it overnight. You're damn straight I'm going to do it over time.
This is Bloomberg.
I think I was wrong then about the path that inflation would take. As I mentioned, there have been unanticipated and large shocks to the economy that have boosted energy and food prices.
It is not something that you hear every day from a Treasury Secretary. For more on Janet Yellen's surprising remarks, want to go to Bloomberg's Anne-Marie Hardern joining us in Washington. Anne-Marie, this is all sort of the White House's push to start controlling the economic narrative, right? I feel like there was a flood of officials over the last 24 hours trying to place the blame and trying to do mea culpas.
Yeah, there is definitely going to be a concerted effort for the month of June. There seems to be a lot of angst within the administration, according to this NBC report, that the president hasn't exactly liked how the communications have gone regarding a lot of these issues. And when you look at inflation and some of the recent polls, one earlier this month was more than 9 in 10 Americans think at a minimum inflation is a huge concern, and they don't like the way the administration is handling it. So you're going to see a lot of communication from this administration. Yesterday, we heard from Treasury Secretary Janet Yellen a mea culpa, saying maybe we got this wrong, or we did get it wrong in terms of the path forward for what we thought inflation or how high inflation would get. But there is an issue in the sense that the administration says that they are doing everything they can, but then when you ask them questions like, well, where are you on the China tariffs, for instance, something that has been, dealt with potentially as a means to shave off some level of inflation, they don't have answers yet. So this is going to be a month where I think there's going to be a lot of questions of the administration if they're serious about doing anything to bring down inflation. What exactly are those actions? Because right now, a lot of it is rhetoric. It was a photo op with Jay Powell. We've had 2 op-eds, and it's been a slew of officials on television networks, as you pointed out, Alex.
Anne-Marie, good morning to you. So what are we hearing from President Biden then? Or give us the context, I suppose, because in international financial markets, we like to talk all the time about what the Fed is doing and the Fed's role in fighting inflation and the independence of the Fed. But I imagine that's not necessarily how Main Street sees it in the U.S., or at least they need maybe reminding by politicians that there are others responsible for fighting inflation too.
That's a great point, Anna. And actually, Guy and Alex asked this to me yesterday. How many people in America know who Jay Powell is? And I didn't know. But I looked back at a poll in 2014 when current Treasury Secretary Janet Yellen was the Fed chair. She was named Forbes' most powerful women, and yet only 24% of Americans, when asked who she was, knew who she was. 24%. So this moment with the president standing next to Fed Chair Jay Powell, who just got his second confirmation from the Senate to be the helm of the Fed, is really the president saying, passing the buck a little bit, this is the Fed's responsibility. They are responsible for the unemployment rate, and they're also responsible for consumer prices. This is something that, as you say, a lot of everyday individuals need to be reminded of, because when you see gasoline, another record today, $4.67 going up, when you see your groceries going up, you blame the individual sitting in the Oval Office. You don't necessarily think of the Fed chair.
Yeah, so the emphasis maybe from Powell on the independence, but with that independence comes responsibility presenting Jerome Powell. Anne-Marie, thank you very much. Anne-Marie Hardern outside the White House, of course, for us. Coming up on this program, we're talking markets and bargains in a time of inflation. Our exclusive interview with the co-chairman of Oaktree Capital, Howard Marks. He sat down with our colleagues at Bloomberg TV to talk about these markets. More detail from Howard Marks coming up shortly. This is Bloomberg.
We're about an hour into the U.S. trading session. We got a pretty strong ISM manufacturing number. Demand really holding up quite well. Now, that actually spurred a little bit of a risk-off move. You have yields on the front end surging higher. Dollar on the highs of the session. Stocks dropping to session lows. Let's dig beneath that a little bit now with Bloomberg's Abigail Doolittle. Abigail?
Well, Alex, that's a great setup because it's really interesting to see this because, of course, on the open we had stocks higher, but right now that S&P 500 down about 0.6%, the NASDAQ down 0.3%, having everything to do with that ISM number coming in stronger than expected. Perhaps it means that the Fed's fully on course. They, of course, floated the idea of having flexibility later this year, but if the economy is okay and does not need help, it could maybe create the path to continue raising if needed. In any case, we have some more volatility for stocks. Crude is up 1.6%. This, of course, on the possibility, the report that OPEC Plus may consider dropping the plus and exempt Russia from its targets. There's also super tight inventories. So we have crude oil at 116. And to Alex's point, take a look at that 2-year yield backing up 10 to 11 basis points. So right now, an interesting day here with stocks down, bonds down, and crude oil higher. Now, what is also lower is the housing market in terms of the number of the mortgage rate here for the applications, for mortgages. Not surprisingly, in the bottom panel here, down for a third week in a row. This as the 30-year average rate for mortgages. It's been trending off of the high, but nonetheless, it's ticked back up just a little bit. So that, of course, created a little bit of an issue for the home builder sector. As for sectors on the day, the energy sector up 1.2% in line with oil trading higher. We also have software and services higher, up about 0.6%. This after CRM, Salesforce.com, put up a great outlook saying that business demand for enterprise software is still very, very strong, and that stock itself up more than 10%, helping out that sector. Communication sector, services up a little bit at this point, and then we see airlines. This is an interesting turnaround because earlier airlines had been sharply higher, now down 3.5%, maybe having something to do with the oil. But we do, of course, know, Anna, that Delta Airlines joined both United Airlines and Southwest in terms of reiterating and raising the revenue guide because demand remains strong. But the airline sector not following along right now. We'll be digging into that.
Yeah, aviation under pressure today here in Europe as well. A tough week, one where European aviation businesses were hoping to make quite a bit of money with lots of vacations taking place certainly here in the UK. But it's proving difficult to get up to speed, to get up to capacity for those aviation businesses. Thanks to Bloomberg's Abigail Doolittle with a look at the markets there. Now, Howard Marks thinks it's a good time to be a value investor. Marks is the co-founder of Oak Tree Capital Management, the largest investor in distressed securities worldwide. He spoke with Bloomberg in an exclusive interview.
Attitudes are more balanced today, but when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. So we're happier today than we were 6 months ago. I don't know if we're going to be happier 6 months from now. That is to say that the bargains will be more pronounced. But at least, as they say, the bloom is off the rose.
At a time of such incredible uncertainty, how do you position seeing value now, but also preparing for seeing more value in 6 months?
You know, one of the 6 tenets of Oak Tree's investment philosophy, which we established when we started in April of '95, and I've never changed a word, and I believe in thoroughly, is that we're not market timers. And that means mostly 2 things. We never sell to raise cash to prepare for a decline. And we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. If it's cheap today, we buy it. If it's cheaper in 6 months more, we buy more. And I think that works much better than an assertion that we know where the market will be in 6 months.
This is really important at a time when so many pensions and institutional investors have been shooting for that 7.5% to 8% bogey. We talked about that extensively in the past 5 to 6 years. This idea that seemed completely unachievable in an era of quantitative easing. Suddenly, high-yield bonds have an average yield of more than 7%. Is this the best period that you have seen for pensions to actually hit their bogey for more than a decade?
Well, I think that's right. Well, of course, many have hit their bogeys. It just didn't look in advance like they would, but the stock market and many other things have surprised on the upside for the last 10 years. But now, as you point out, one of our big activities is high yield bonds. And a year ago, they were yielding in the 3%. One deal was even done in the 2s. That's not a very high yield for high yield. Today, as you say, they yield in the 7s. So a pension fund that needs 7 or 7.5 can make use of high yield bonds. And everything, you see, when everybody gets concerned when prices decline. But if you flip that over, the flip side of price deterioration is increases in prospective returns. So now the prospective returns on many asset classes are higher than they were just a little while ago. And again, a much better climate for the bargain hunter.
Some people would counter this by saying inflation takes a lot of the value out of those returns, that basically on a real basis, you're still not getting very much. How do you counter that as a long-term investor by saying, you know what, at this point, it's worth it to get higher returns, even if on a real basis, it's not necessarily that much more?
Well, you're right in that we're not talking about an increase in real returns. We're talking about an increase in nominal returns. Most pension funds and other organizations reckon their need for return in nominal terms. But I mean, that is a challenge. And nobody knows what inflation is going to do. I think I heard out of one ear your previous guest say that some of the inflation factors will probably subside in the next few months, which means, all things being equal, an increase in real returns.
That was Howard Marks, Oaktree Capital co-chairman, earlier today on Bloomberg Television. All right, coming up, the political climate in Latin America and how it is affecting investments. We're going to speak with private equity investor Oscar Dicatelli, DXA Invest CEO, coming up next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the U.S. President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 15 miles away. The U.S. says Ukraine has promised not to attack targets inside Russia. In New York State, Governor Kathy Hochul and legislative leaders pledged to raise the legal age to purchase an AR-15 assault rifle to 21 years old from 18. They also say they'll pass a package of measures to tighten gun laws this week. Officials cited the recent mass shootings in Uvalde, Texas and Buffalo. In Colombia, the peso rallied after construction mogul Rodolfo Hernandez defied the polls to secure a place in the election runoff later this month. That reduces the chance that leftist Senator Gustavo Petro will be the next president. Hernandez is something of an unknown, but he is seen as a safer bet for business interests. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
All right, thanks so much, Ritika. Let's stay in Latin America for a moment. So we have that election uncertainty in Colombia. Brazil has a presidential election in October where former President Da Silva, the leftist, is really looking to stage quite a comeback. And on the economic front, Latin American economies are dealing with high inflation and a high U.S. dollar and questions about the strength of the consumer, just like everywhere else. So joining us now to discuss investments in Latin America is Oscar Dicotelli, a DXA Invest CEO and founder, joining me here on set. Oscar, it's a pleasure. Nice to see you.
Yeah, it's great to see you again, Alex, in person. It's been a long time since I've been here in New York.
It has been quite a long time. I got your name right, and that feels like a huge, his name is one I couldn't say forever. So the climate from where you sit, you invest in private equity, mid-small companies, mostly geared towards the consumer. Where are you right now?
Well, Alex, I think what's going on is really kind of an example that it's not about macro, right? So we're seeing a lot of bad information on the macro side, as you were mentioning, inflation, the slow growth, and even on the election side, there's a lot of discussions to happen there. But when you look in terms of the underlying companies, venture-related, tech-enabled companies, innovation-related, it's a new market. It's a different setup. We just saw, for instance, in Colombia, we just saw last month a new unicorn coming out of Colombia with international big funds investing and backing that company, just to give you an example.
But do you need, so are we talking like those technology exposed to the consumer, and then do you need a strong consumer? Do you need the macro to hold up for that to continue to happen?
Not necessarily. I'll give you an example. So when you think about Latin America from a macro standpoint, it would say there's no security, there's political instability, there's poverty. And when you look from a couple of different companies, they're resolving those problems. So I always say about Uber, right? Because there's no security there, the three best cities for Uber are in Latin America. Mexico City, Sao Paulo, and Rio are the biggest number in terms of number of rides. And you say there's political instability, and there are companies that are doing, for instance, cameras, surveillance cameras that they're using to pile up that information to resolve something that the government's not doing. So I think that the fact that you have big problems are now becoming more and more a big market and landscape for you to be able to tap into that with technology.
Oscar, good to see you. So security becomes a business opportunity there where governments are absent, then private business can make some money. Let me ask you about, though, some of the macro themes and how they do impact the kind of private equity deals that you're doing. Because, I mean, the Fed with its tighter policy, private equity has been a big winner, of course, from low interest rates. A lot of money allocated in that direction. Is it harder? Is money harder to come by now?
Look, I think, of course, money is a little bit harder than what we saw in the past. We're still seeing massive drives of growth in terms of the volumes that are coming into the region. So I'll give you an example. If you take a percentage of tech-enabled companies versus GDP, Brazil and LATAM is about 2%, okay? India is at 14%, China 40%, and the US 70%. So there's still a long way to go there. So you're coming from such a low base that it's not impacting that much. However, we are seeing, especially in the deals that we're doing, when you start putting interest rates into that deal. So you do things like a debt that has an interest and it converts on the next round, and you're starting to see things, well, especially in Brazil, that now interest rates are at 12 3/4. You have to factor that into your deal. So I think that funds and investors that can be kind of a little bit more flexible, and definitely the companies are open to that, you're able to factor in the interest into those negotiations.
So tell me about maybe the most recent deal that you did, and then maybe one area that you're most excited about.
So we do have a strong view in terms of consumer kind of changes, right? We've just done a deal in Beauty Tech. It's a company that started off basically, it's called Beauty for All. Basically, they started giving kind of small kits that people that would kind of pay on a monthly subscription side, right, to have the newest lipstick, and then that drove into an economy for second income. So now these creators and influencers, they buy these subscriptions, but they set up their online shops and then use the internet to drive that. So when you got into a situation where income is not very well and everything, you started to have bigger subscribers because people were looking to use that as a way for a second income. And now they have about 100,000 subscribers on a monthly standpoint and 1 million people that really kind of run that network. So I think there's a lot of different things that are happening in the landscape, and it's not just Brazil, it's Colombia, it's Mexico, all across Latin America that we're seeing these kind of opportunities.
Okay, subscription models then of interest to you, Oscar. Let me ask you about clean tech. We're going to talk later this hour about electric vehicles and expectations for their future development. But around clean tech, are you finding interesting ideas on that theme, Oscar?
For sure, Anna. Well, first of all, we're seeing a huge impact of investments towards solar, towards wind energy also, especially in Brazil. There's some new legislations around it. We're looking a lot at clean tech, for instance. You have companies that use technology for you to reduce the expenditures around, for instance, private planes. This is a deal that we're currently looking at, for instance, where you have like a NetJets here, just to give you an example. Similar situations that are using there also. These are definitely drivers of clean tech movement. Brazil already has, specifically Brazil, already has one of the cleanest matrix of energy in the world. And I think that we're seeing now these big investments towards solar and wind. They're definitely going to drive like the big change. Just to give one example, in the northeast of Brazil, the load factor for wind is about 65% efficiency. You look in the Nordics, it's 40% efficiency. And now they just issued a law where they're going to allow for you to have offshore wind turbines. So this is something that's still at the verge, at the beginning. So when you see market volatility like that, it doesn't impact that much because it's coming from such a low base of low amount of capital is being invested in there.
So let's just go macro for just a moment.
Yeah, of course.
You mentioned the high yield and sort of what that winds up doing when you're factoring in your investment and issuing debt. What about inflation? Like, how do you look at inflation and then eating into your returns? Like, do you just change your profile?
Well, I think you do need to factor in specific products that you're investing in that will use inflation as an aspect. So if it's gasoline prices that's going to generate an impact into that company, you should be shying away. We are doing that, of course. But I do think that macro will impact, from a political standpoint, will impact the landscape of innovation being driven. So we've seen a lot of new legislations to allow fintech to operate freely. We're looking at things around health tech to be freely. If we do have the impact of inflation affecting the political landscape, and then you see a backdrop of the mentality towards a pro-business region, then that's, I think it's something that becomes a bit more risky.
Oscar, let me ask you that about pro-business and how pro-business some of these geographies are. We started our conversation talking about Colombia, where somebody who is relatively pro-business and pro-risk assets is now going to be in the runoffs, and maybe that was a surprise to some people. Are there geographies, countries, where you feel you have a more pro-business backdrop, or are you saying the opportunities don't really correlate with that?
Well, I think it's quite interesting. What happened in Colombia, for instance, is a discussion with Hernandez coming now into the second round, is really showing that the population, they want to change. They don't want to see the old politicians in power, right? We saw that in 2018 in Brazil when Bolsonaro came into power. Although he was a long-time politician, wasn't somebody that was really kind of on people's mind, right? So I think what we're seeing in Colombia also is especially the younger population that was really kind of connected to Hernandez with TikTok, like they call it TikTok king, right? We saw that this is the same population that wants more innovation, wants more products. So I think that Colombia has a great setup for the future. Brazil has it, Mexico has it also. Even in some stances, we're seeing a lot of interesting opportunities that come come out of even Argentina. That's in such a difficult moment, but it's through innovation and technology that we're starting to see companies that are kind of resolving those issues for the general public.
Oscar, it's really good to catch up with you.
Yeah,
really
it's
appreciate
great.
seeing you in person. Oscar Dicatelli, DXA Invest CEO and founder. Thank you so very much. All right, coming up, electric vehicle sales are expected to soar in the next few years. We got a new report from Bloomberg that says that's not enough to get to carbon neutrality. More details on that next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Shares of Salesforce are rising today. The company raised its annual